Robert Cohen is Director of Global Developed Credit over at DoubleLine. And Robert, I am curious about this. I know a lot of people are fretting about some of the recent borrowing that we've seen as people sort of chase these AI dreams. But we'd be remiss in not pointing out that, at least so far, the vast majority of these borrowers are coming into this with incredibly healthy balance sheets by pretty much any metric that you would normally see. Does it give you concern at all about the level of borrowing or the type of borrowing that's being done?
I think the borrower matters. You mentioned that many of these are from very high quality companies, so Alphabet, Microsoft. But spending money on data centers isn't really a problem. Oracle's balance sheet, on the other hand, has been increasing in debt, and they've gone cash flow negative. And then as you go down the credit spectrum, you start to see more and more speculative borrowing. And the market's pretty much figured this out. The risk tiering is pretty efficient. So investment grade credits yield, I don't know, high fives to maybe 6 for credits in the AI space. And then in high yield, you see anywhere from high sixes to over 10%. Yeah. And so it really depends on how close you are to one of these so-called hyperscalers. Mm-hmm. For credits that are well supported by them, spreads are tight and their credit risks are relatively contained. When you are on your own without the support of one of the major players, so-called hyperscalers, you become a lot more speculative, and you see that in the spreads that the market demands for those credits.
Well, I'm curious, so given the uptick in activity, and obviously you get paid a lot to sort of sift through all of this, separate the wheat from the chaff, if you will. But the big theme, certainly in public markets all year long, has been AI. To a certain extent, it's been M&A activity, and that, of course, is also the big theme that we've seen, at least in the second half of the year, with regards to the credit space. Does that continue through 2026?
Oh, I think the party just got started here. We've gone through a period of basically credit creation being in decline, meaning that the amount of credits have actually been shrinking. Corporate credit has been in decline, really across fixed income. The size of the markets have been in decline. Now we're seeing an uptick. M&A has been below trend since the pandemic. And I think this is really just the very beginning. So while people are pointing to a few transactions here and there, I think 2026 is going to look a lot different, where we have growth in M&A and growth in credit creation. And so there's going to be a lot more to see as we turn the page into next year.
Well, looking forward to next year, one of the points that you make in your notes that you sent over to our producers is that you would expect that credit returns could be competitive with equities next year. Mm-hmm. Robert, that feels like a big call. Does that say something about the equity market, perhaps in a downdraft, or does that say more about credit really outperforming here?
Well, if you take out AI, it's not a big call, because the S&P equal weighted is up about 10%. High yield corporates and investment grade credit are nearly tied at about 8% total return for the year. So you gave up, if you didn't buy the S&P equal weighted and you bought high yield, you would have given up 200 basis points, which is something, but not a whole lot given the volatility differences. And so the point being, if you strip out all the AI stuff, the returns aren't that different. And I think next year, the story about equities broadening out, the returns being from more stocks beyond the Mag 7, I think that could, if that ends up happening, you'll have a diluted sort of return profile. Let's say high single digits. That sounds like something you could do in credit. So volatility adjusted, I think equities versus high yield or some forms of credit seems very attractive. If you think about the fact that we could certainly have volatility next year, people forget we're ending the year pretty well, but we had something in the middle called tariffs. There was one pretty large bout of volatility in the mid-year, and credit did better through that than equities, and then of course we had all the technology stuff take off. And people forget that there was volatility. So I think if you consider that volatility is certainly a possibility for 2026, mm-hmm. I think credit can be quite competitive with equities.
Yeah, the tariff tantrum, it certainly feels like a long time ago. So when you're talking about credit returns in 2026, I assume you're talking about public credit. How does private credit wrap into that conversation around returns?
Yeah, well, I think quite simply the private credit trade, the alpha is over in private credit. It was a tremendous opportunity in 2020 during the pandemic when public markets were shut down and private credit was the only source of capital. But now we're seeing the returns converge. So I don't think there really is any advantage in private credit. You could actually argue that there's a pretty good chance that private credit does worse than public credit next year because of the low credit quality and concentration. Most, and I'm generalizing, but most private credit portfolios are over 80% B- or below. And they're highly concentrated in sectors like technology. They can be as much as a third or more in the technology space. That is not analogous with the public markets that are broadly diversified, that are diversified not only by sector, but by rating cohort. And most, well, let's just take high yield. High yield is mostly double B. So you're comparing a double B index versus a B- index. Depending on your outlook for risk, they're going to perform very differently. I think our view here is that the weakest areas of credit, the lowest credit tiers, are the most exposed to losses or at least poor performance. And so under that scenario, the up in quality characteristic of the high yield index just looks a lot more attractive for similar yield.
Well, then I am curious. I mean, obviously, that's the existing portfolio out there. With regards to new issuance, do you also anticipate it will be much higher quality overall?
Well, it's hard to anticipate what will happen in the future. All I know is so far, high yield and investment grade credit have been improving in credit quality. And there hasn't been much in the way, well, triple Cs actually have been dropping in terms of issuance over time. They've been going to the private credit market. So what happens next year? I don't know. It is certainly possible that we see a re-emergence of lower quality credit in the high yield market. But it would take some time for it to deteriorate into looking something like private credit. I just don't anticipate that at all. And you're starting from such a high quality level that I don't think it's an issue really to consider right now. Maybe as we get into 2026 and into 2027 is when we start to worry about things. And I also just point out that for any sort of talk about bubbles and things like that, excesses build when you have a high degree of issuance and M&A transactions, and we haven't had that.
Right.
When I talk about issuance, I mean net new issuance. And so I think next year is the year, maybe be on watch, but nothing really alarming immediately as we end the year here.
All right, Robert, hope to pick up this conversation in the new year. Great to get some time with you. That is Robert Cohen. He is Director of Global Developed Credit over at DoubleLine.